Have you ever really stopped to think about what a bank does? I mean, really does. It's so much more than just a place to stash your cash. Today, we're going to crack open the hidden engine of the entire financial world. And you know what? We've got our hands on the secret playbook that shows exactly how it all works. So let's dive in. Okay, so let's start with the most basic question of all. We tend to think of banks as places for our deposits and maybe for getting a loan. But that's just scratching the surface. What is the fundamental business? What's the real engine that makes the whole system tick? Well, here's the answer, and it might surprise you. A bank, at its very core, is a professional risk machine. Seriously. Its real product isn't money, it's the sophisticated, calculated management of risk. Banks are designed to take on very specific risks that you and I wouldn't want to, and they figure out how to turn a profit from it. That is the whole game. So how do we know this for sure? Because we have the playbook. And for this explainer, we're using a fascinating one. Germany's MARISK. It translates to the minimum requirements for risk management. Think of it as this hyper-detailed rulebook from Germany's top financial regulator, BaFin. And look, while it's German, the principles inside are absolutely universal. It's the perfect guide for understanding the DNA of any modern bank. The playbook kicks off by identifying 4 absolutely essential, non-negotiable risks. I like to call them the 4 horsemen of banking. Why? Because every single bank, no matter where it is, has to master these 4. If they don't, well, they're not going to be around for very long. First up is the one we all kind of get instinctively, credit risk. Or, in the language of the playbook, adressena ausfall risiko. This is simply the risk that someone who owes the bank money just won't pay it back. But for a bank, it's not a simple yes or no guess. They are constantly running complex calculations on the probability of default and the potential loss given default for every single loan they have. And here's where you see the playbook gets really serious. It doesn't just define the risk, it demands action. It says that if a bank has a growing pile of bad loans, or not leidender Risikopositionen, it must create a detailed strategy with clear targets and KPIs to actively get that number down. It's a mandate for proactive problem solving, not just watching things get worse. Okay, the second horseman is market risk, or marked price risiko. This risk has nothing to do with borrowers. This comes from the wild world of the financial markets themselves. When a bank invests its own money, it's exposed to huge losses if interest rates swing or stock prices fall or currency values shift. They try to measure this with these incredibly complex models to calculate their value at risk, trying to predict the absolute most they could possibly lose on any given day. This is a perfect window into how banking evolves. The playbook's own commentary explains that the wild market swings that started in the 1970s created this huge demand for tools to protect against that volatility. This led to the invention of complex things called derivatives, which are used to hedge, to ensure against big market moves. But of course, these complex instruments created a whole new world of risks all on their own. Let's move on to our third horseman, liquidity risk, or liquiditätsrisiko. This is one of the most primal fears in banking. It's the risk of just plain running out of cash. To prevent this, regulators force banks to keep a minimum liquidity coverage ratio, which basically ensures they have enough high-quality, easy-to-sell assets to survive a full-blown 30-day panic. And yep, this is the risk behind that classic bank run you see in the movies. If too many people show up demanding their money at once and the bank can't pay, confidence just evaporates, and the entire institution can fail in a matter of hours. That's why managing liquidity is an absolute obsession for both bankers and the people who regulate them. The fourth and final horseman is operational risk, or operationelle Risiken. You can think of this as the ultimate catch-all category. It's the risk that something, somewhere, inside the bank's machinery just breaks. Could be a person making a huge error, a critical system failing, internal fraud, or even external events like a fire or a massive cyber attack. And the playbook is very much living in the 21st century. It specifically mandates the immediate reporting of any serious operational or security incident. So think of major data breach or a payment system going down. The bank has to tell the regulator instantly. And it's not just to fix its own problem, it's to act as an early warning system for the entire financial network, helping other banks defend against a similar attack. Okay, so we've met the 4 horsemen. We know the big risks. But identifying your problems is the easy part. The real genius of this playbook is the system it describes for actually managing and controlling all that chaos.
And right at the heart of it all is this 5-step process. Now, this isn't a checklist you do once. It's a continuous, never-ending loop. It starts with Identifikation, finding every possible risk. Then Beurteilung, assessing how much damage it could do. Next is Steuerung, actively managing and controlling it. Then Überwachung, constantly monitoring the situation. And finally, Kommunikation, reporting the status up and down the chain of command. This cycle just repeats, constantly, forming the core of the bank's defense system.
So, what is the ultimate goal of that whole 5-step cycle? It all comes down to ensuring the bank has what the playbook calls Risikotragfähigkeit, or risk-bearing capacity. It's a fantastic concept. It asks the ultimate question. After all is said and done, can this bank actually absorb the losses from all its risks and still survive? This is the final pass-fail test for a bank's resilience. When you put all these pieces together, the strategies, the processes, the controls, the capacity analysis, you get what the Germans call Gesamtbanksteuerung. It means overall bank management, but it really conveys this bigger idea of a holistic, disciplined, totally integrated system for steering the entire bank through a sea of constant risk.
But here's the thing, risks don't just stand still. They're always evolving. So to prove this playbook is a living, breathing document, let's look at the newest chapter that's being written right now, Environmental, Social, and Governance, or ESG risks.
You can draw a direct line from global policy right into the banking rulebook. It starts in 2015 with the Paris Agreement on Climate. By 2018, the EU has a plan to finance a green transition. And today, what the playbook calls nachhaltige Risiken, or sustainability risks, are a formal, mandatory part of risk management for every single bank under these rules. The global conversation has become a binding line item. And what does this mean in practice? It means banks now have to run climate stress tests. They have to model what a future with more extreme weather, that's physical risk, could do to all the properties they've issued mortgages on. And they have to model how a global shift away from fossil fuels, that's transition risk, could impact all their loans to, say, the car industry or energy companies. This is a whole new dimension of risk.
So, after looking through this whole playbook from the classic risks to the absolute cutting edge, what's the ultimate takeaway? What's the core lesson here?
It's this. The entire system is a constant, high-stakes balancing act. Banks need to take risks. That's how they make money, and it's how they fund the economy. But those same risks have to be rigorously controlled to prevent the kind of massive collapse that can take down everyone. This playbook, it's really the blueprint for managing that fundamental tension. Which, of course, leaves us with one final question to think about. From cyber attacks to climate change, we know the nature of risk is constantly changing. So in a world like that, can a rulebook, no matter how detailed or how smart, ever truly be finished?